The coronavirus and its effects on daily life and the global economy continue to be the main focus. The number of coronavirus cases globally will undoubtedly continue to rise. As the numbers rise, traders and markets will be watching the response of individual governments to see if they are doing enough to contain the virus. The dollar rose last week as a collapse of equity markets and disruption to sovereign bond markets unveiled a large shortage of dollars. Moreover, in a surprise Sunday announcement, the Federal Reserve cut its key interest rate by a full percentage point to near zero and said it will boost its bond holdings by $700 billion. It was the latest attempt to save an 11-year economic expansion from the pandemic, which threatens to throw the U.S. into recession if it hasn't done so already. After starting last week by selling off to levels not seen since September 2018, the US dollar index surged back to close at 98.75 on Friday and posted a 1.99% rise week on week. Initial support is seen near 97.20. Meanwhile, the ECB said on Thursday it will provide banks with loans at a rate as low as minus 0.75%, below the 0.5% deposit rate, essentially giving them a rebate, and it will increase bond purchases by 120 billion euros this year. This should be enough to shore up economic growth, but investors said the effectiveness had been dented by ECB Chief Christine Lagarde's off-the-cuff remark that it was not the central bank's job to help close spreads. That was a reference to the yield spread of premium over German bond yields that riskier Southern European countries must pay investors when they borrow. The euro spent the most part of the last week selling off. It closed at 1.1106 against the greenback on Friday, posting a 1.2% decline for the week. The follow-through selling could see a retest on the $1.08 area. Resistance is seen near 1.1150. Meantime, sterling fell steeply against major rivals last week. The pound's week-on-week drop of 5.9% to 1.2277 by Friday's close was bigger than the week of June 2016 referendum, 4.7%, and the flash crash in October, 4.1%. It was the biggest loss since the 6.3% drop in a week in January 2009, during the heart of the financial crisis. Nearby support is near $1.22, and a violation could open the door to $1.20. Although Britain has been fortunate enough so far to enjoy one of the lowest per capita coronavirus infection rates, perhaps because of its segregation from mainland Europe, its infection numbers have risen rapidly in recent days, and the UK is bracing for a further surge in infections as the outbreak gets underway. This could have significant downside implications for the pound. Although the crypto number one closed in the green on Friday at 5,625.40, it still posted a sharp weekly decline of 36.2%. So do Bitcoin bulls have any hope? Yes, fortunately, some analysts currently see a bull case forming for Bitcoin that may mitigate some of the downside risks. In commodities, Saudi Arabia's announcement that they will push back against Russia in the oil production game and pump as much oil as possible sent oil prices into a downward spiral. Russia said they would not cut back their output, although OPEC had agreed to. Brent crude rebounded a little to $33.85 a barrel on Friday, but this did not help much to the 32.3% plunge for the week. The oil market is being sent deeper into turmoil by an unprecedented coincidence of both demand and supply shocks. Widening global efforts to fight the spread of coronavirus are set to trigger the most severe contraction in annual oil demand in history. The WTI barrel settled at $31.70, losing 24% from a week ago. Meanwhile, as equities collapsed and financial stress soared, the price of gold settled at $1,516.70 on Friday, losing 9% for the past week, which appears to be the largest fall in 30 years. Gold's liquidity and recent strength worked against it as investors appeared to sell their gold to cover losses, margin calls elsewhere. You've watched a combined review of currency and commodity markets on Insta TV. Bye.